Welcome to the daily briefing from interest.co.nz. I'm David Chaston. Today we review the latest credit card use trends, we update our risk premium review, preview this week's OCR announcement, and we'll wrap up with what the other media are reporting. The credit card data for September shows some trends that will be worth watching. Growth in total electronic card transactions for the month fell to 7.7%, while transactions put on a credit card rose to 9.2%. That strongly suggests that consumers have been using their debit cards less and their credit cards more. That suggestion is reinforced by data that shows that credit card balances are growing faster, and the proportion of those balances that incur interest has risen about 0.5% to 67%. While these shifts are small, they do look like the long-term downward trend in balances that incur high credit card interest may be ending. When consumers choose to use more credit card funding, it is a sign that credit stress is rising, and that would be consistent with household budgets that are coming under pressure as high mortgage and rent payments take their toll. Watch out, the consequences of the international credit crunch could still hit us with a wallop. Tomorrow we'll have more on the international pressures that will shape our access to housing credit, but today we want to review again how our mortgage pricing is set with the risk premium components. Going against recent trends, this week saw a sharp fall in yields for US Treasury paper. The demand for risk-free instruments rose as investors took renewed concern at the way the credit crunch is playing out. But here in New Zealand, our government bond yields fell very little, and our wholesale swap rates also adjusted very little. The effect was to raise the risk premium for New Zealand dollar funding, especially for 5-year money. Not helping is media comment and debate that questions whether the current regulatory responses are going to work. Ex-US Fed Chairman Greenspan has been very vocal in questioning this, arguing that the regulators should not flood the market with covering credit. He wants banks to have to sell their dodgy paper for a big loss so that the markets learn the lessons of the subprime mess, and so that a swift, sharp clean-out can set the system up for a better way forward. If this happens, no doubt the international financial system will be better off, but the impact on mortgage rates and access to credit here could well be ugly. There is universal agreement that this Thursday's OCR review will see no change from the 8.25% it is currently set at. But that may be where the consensus ends. Firstly, Westpac and now Infometrics have looked ahead into 2009 and see the OCR going up from here, not down. Infometrics sees 2 increases in 2009, taking the OCR all the way up to 8.75%. And the reason is that there is a developing sense that inflation is about to bite much harder. Firstly, and more immediately, international oil prices are about to put a strong upward pressure on inflation. Westpac has produced a ready reckoner that shows clearly that even without an exchange rate drop, the inflationary pressure will be significant. And if we have a fall in our currency, that pressure will increase. And secondly, the combined effects of the dairy boom payout and electioneering promises will more than offset the expected impact of the housing slowdown. House prices may slide in 2009, but price inflation will rise. The wealth effect could take a real hit. And finally today, a quick wrap-up of some other recent news. The NZIER has developed a simple tool to check how you would fare on an after-tax basis if you were working in Australia. They conclude that arresting the migration of Kiwi workers to Australia requires incomes in New Zealand to grow at a rate faster than we've seen in the recent past. This requires an environment that rewards productive activities and that attracts and retains skilled workers in increasingly competitive and global labour markets. People's incomes are either spent, saved or taxed. If savings are negative, this means spending or taxation, or both, are too high. As a recent New Zealand Herald opinion piece points out, there is something disturbing about middle income earners being reliant on government assistance like Working for Families to be able to raise a family, particularly during a period of economic prosperity. You can get more news and start with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web. We'll see you then.